Without further ado, I'm going to turn it over to Assembly Member Torres.
Thank you so much. Thank you, Carolina. Thank you, Nancy, to everyone at EDCAP. Thank you so much for partnering with us and my office to put on this fantastic webinar. My name is Emerita Torres. I'm proud to represent the 85th District and here in the South Bronx, including Hunts Point, Longwood, and Soundview. The Community Service Society was my former policy home, so this is tremendous. I'm so excited to be partnering with the Community Service Society because I believe wholeheartedly in all of the work that you do. And the testament is that I've worked there. Really, really excited for this webinar and for EDCAP to present on this issue because student loans affect so many of us. I am someone who was deeply impacted financially from my student loans from my undergraduate education and my graduate school education. And student loans affect millions upon millions of people across our communities, from recent graduates who are just starting out to working families to seniors. It affects everyone. And there's so many people that are carrying loads and loads of debt with no sort of end or pathway in sight. And given all that's happening at the federal level, it's extremely important to be in the know about what's happening, how it's affecting you, and just to have clear and accurate information and support from organizations like the Community Service Society and like EDCAP, who are really truly the experts on this issue. So that's why we're here today, to provide that information, to arm you with all of that information, to make sure that you have the options at your fingertips, that you make informed decisions about your financial future with regard to student loans, because knowledge is power, information is access to power, and that's really what tonight is about. So thank you again to EDCAP for doing this, to Carolina, who has been someone that I've worked with in the past, and thank you, Nancy, as well, and to my constituents for being on this call with us tonight. So thank you again, and let's get started. I'll pass it back over to Nancy.
So a few little housekeeping items before we start. I'm going to be doing the presentation. If you have any questions, feel free to type them into the chat. Yarek Munoz, who works with Assemblywoman Torres, is going to be monitoring the questions, and we'll break periodically to answer some of those questions. So with no further ado, I'm going to turn my video off and I will share my screen. And if somebody can just confirm that you can see the screen, that would be great.
Yes, we can.
Okay. So we'll get started. And we're going to be talking, as we know, about student loans tonight, and specifically going over what we call the new era of student loans, with all of the changes that are coming down the pike as a result of the new budget bill. So this is the agenda we'll go over. We'll get to each bullet point as we get there. But we're going to start with a little information about EDCAP. So EDCAP stands for the Education Debt Consumer Assistance Program. We are a program initiative of the Community Service Society, or CSS. CSS is a large nonprofit that's been around for over 180 years. The EDCAP program was established in 2019 specifically to tackle the issue of student debt. Student debt is the second largest consumer debt in the country, after mortgages. It's about a $1.7 trillion issue nationally. And the reasons that EDCAP was established was, number one, because of the size of the problem. And number two, because, as many of you know, the complexity of the system, particularly over the last 4 or 5 years, is sort of off the charts and very, very difficult to navigate. There are options out there for people, but people don't know what they are or how to access them or make them work. And that's where EDCAP comes in. We are a New York State funded organization, so all of our services are free, including these free webinars. But as you're listening to this presentation, if you feel that you need a one-on-one consultation, feel free to reach out to us to get that one-on-one attention. Those counseling sessions are free. We'll have the contact information later. We also, I do want to mention, have a network of 10 different organizations around the state, soon to be adding another one, that offer these services in their respective communities. But they are also, many of them are legal aid organizations. EDCAP itself does not, we do not litigate as part of the EDCAP program. But if you've got somebody that's got a legal issue, usually surrounding a private loan or a institutional debt, we may be able to help out there by referring to one of our network partners as well. And we can, by the way, help you with all things related to student loans. We pretty much cover the gamut from the time that you are investigating how to fund your education to enrolling or to filling in the aid applications like FAFSA, TAP, Excelsior scholarships, all the way through to managing your loans and hopefully eliminating them either through paying them off or through forgiveness programs. Okay. So I want to start with some important updates. And if, working in the world of student loans over the last 5 years, there's pretty much an update a week. But this was a big one that came out in the last week or so. The Trump administration announced that they formed a partnership with the Treasury Department called the Federal Student Assistance Partnership. It's what they call an interagency agreement that is going to pave the way to have the entire $1.7 trillion federal student loan portfolio be managed, the management of that portfolio move from the Department of Education to the Treasury Department. This is supposed to take place in stages, and this fits in with the current administration's goal, which has been to close the Department of Education. Now, the first phase of this transition will be that the Treasury Department is going to assume control of the defaulted loan portfolios. There are an estimated 8, maybe 9 million borrowers that are in default. It's a huge number. It's about over 20% of the entire student loan portfolio nationally is in default. The plan is for them to use their infrastructure of private agencies to carry out collection efforts and also to help with loan rehabilitation, which is a means of getting yourself out of default. Now, I will say that Treasury has always had a hand in collecting on defaulted student loans. So this isn't a huge stretch necessarily from what's happened in the past, but we'll have to see how it pans out. The later stages, phase 2 and beyond, is when Treasury is supposed to, and this is the wording from the press release, provide operational support for non-defaulted student loans and eventually provide support for functions like the FAFSA. The wording in the press release regarding the second phase and the additional phases was very, very vague. There were no timelines associated with that. So it's yet to be seen when that will happen, how it will happen, or even if it will happen. So what does this all mean for borrowers? Well, it doesn't really mean a whole lot right now. Nobody has to take action as a result of this move, not yet anyway. So if you have a defaulted loan, you don't need to do anything. You will continue to contact the default resolution group to discuss the defaulted status of your loan or log into your My ED account to get information and manage your defaulted debt there. Collections are suspended. So there is no involuntary collections happening right now on defaulted federal student debt. They were going to restart it and then they stopped it and then they restarted again and then they've stopped it again. They have not given us a timeline as to when it's going to restart, but our best guess is no earlier than July. Could be longer than that. Ultimately, this entire endeavor could face legal challenges because there are folks out there that feel that this can't be done without some kind of congressional approval. So we'll have to see. Stay tuned, but for right now, really nothing is changing. If your loans are not in default, continue to work with your servicer, make payments to your servicers, and there's no you won't be necessarily interacting with the Treasury Department anytime soon. All right, so we're going to go right into the new rules for student loans. The One Big Beautiful Bill Act, or the OBBBA, as I will refer to it throughout this presentation, is the big budget bill that was signed into law last July. And of course, it affects many different programs throughout the country, but it has some profound impacts on the federal student loan system, some big sweeping changes. And that's what we're going to be talking about today. We're going to start with borrowing limits. So, and these new rules go into effect July 1st of this year. So borrowing Student borrowing for undergraduate degrees, that's where you take out a direct subsidized or unsubsidized loan for your undergraduate school, the student alone. There's no changes to those borrowing limits. The borrowing limits range from $5,500 annually to $7,500 for a dependent undergraduate student, with a maximum $31,000 lifetime aggregate limit for your undergraduate degree. If you're an independent undergraduate student, you can borrow a little more, between $9,500 and $12,500 annually, up to $57,500 in total. The real changes come when we start looking at the master's degrees programs. So, direct unsubsidized loans for graduate school. If you're pursuing a non-professional master's degree, the annual limit is going to be $20,500, which is the same as the current limit. There is a lifetime limit for these degrees of $100,000. This is over and above your undergraduate school borrowing. It also does not include any Parent Plus borrowing. So that is what is going to be available lifetime to pursue a non-professional master's degree going forward. If you're pursuing a professional degree, which is essentially a law degree or various medical degrees, the annual maximum is going to be $50,000 and the lifetime limit will be $200,000. And I believe I have a slide in here that sort of goes over what is considered to be a professional degree. Now, where these changes really make a difference is in these next set of bullets with the plus loan programs. So starting with the graduate plus loans. A graduate plus loan would allow a graduate student to borrow up to the cost of attendance so that they were able to fund their entire education, their entire master's degree in the federal student loan system. So what it did was it looked at the cost of attendance and it subtracted any other aid that student may have already received, like a direct unsubsidized loan or any scholarships and grants that they may have received. And if there was a funding gap, you could borrow graduate plus loans. And those plus loans allowed you to fund the entire degree within the federal system, which has certain benefits, generally more protections, access to better repayment plans and forgiveness programs, which you don't generally get with private loans. Parent Plus loans operate in a similar way. Let me step back. The Graduate Plus Loan program is going to be completely eliminated starting July 1st of 2026. So going forward, a new borrower is only going to have access to those direct unsubsidized loans with the maximums that we just described, either $100,000 or $200,000 lifetime, to complete their master's degree. And in a lot of instances, particularly for more expensive degrees, that's not going to cover the entire cost, which means that you're going to potentially have to look to other types of funding, like private loans, to fill the gap. Parent Plus loans operate in a similar manner. They can only be taken out for dependent undergraduate students. So a parent can't take a Parent Plus loan for a graduate student, but they can take that Parent Plus loan to fund their child's undergraduate studies. And it works the same way. Under the existing rules, you can borrow up to the cost of attendance minus any aid the student is already getting, like those direct subsidized and unsubsidized loans or grants or scholarships. Now, Parent Plus loans are not being eliminated, but they are being limited. So going forward now, for a parent, the annual limit is $20,000 per child. The aggregate lifetime limit of borrowing is going to be $65,000 per child, and they're going to be looking at both parents to determine whether or not you're at the limits. So for people that are attending relatively expensive undergraduate schools, like private nonprofit schools, this may not be enough borrowing. The $20,000 may not be enough borrowing between that and what your child is getting to cover the entire cost of attendance, which again is going to mean that people are going to have to either find alternative forms of funding, like private loans or family resources, or if they can't deal with the extra debt, just find cheaper schools to attend. There is a grandfathering clause that pertains to both Graduate Plus loans and Parent Plus loans. If the student has a direct loan that's dispersed before July 1st of 2026, the graduate students and the parents can borrow under the existing rules. So they can borrow up to the cost of attendance. And they can do this for a maximum of 3 years for the student to complete their program of study. And if the student completes the program of study before 3 years, then they would borrow during that time period, but no more than 3 years. So borrowers that are in this situation will continue to be able to borrow under existing rules, but you have to pay back under the new rules, and that's got some pretty significant consequences for Parent Plus borrowers, which we're going to talk about. So these are the graduate degrees that the department has now deemed to be professional. These are the degrees that you'll be able to borrow up to $200,000 lifetime for, or $50,000 a year. As you can see, it's law degrees and mostly medical degrees. There's theology and clinical psychology at the end. Our understanding is that there also are a limited number of additional degrees that may fit the strict definitions of professional degrees using the broader definitions that they wrote in the new rules. I have not seen a list of what those degrees are, but I can tell you what is not on those lists is what's not included are things like nursing degrees, physician's assistants, social workers, masters of education. All of those fall under non-professional master's degrees. So your lifetime borrowing limit is going to be $100,000 in the federal system. Okay, moving on to repayment options. Well, actually, before I go on to repayment options, I'm going to stop. And Yarick, are there any questions about that first section that I need to address?
Nope, none in the chats as of
Okay.
right now.
Okay. Just a reminder, feel free to type your questions into the chat if you need to ask anything. We'll also, if we have time at the end, we can open it up for people to raise their hands and ask questions. Okay, repayment options. So first I want to talk about the demise of the SAVE plan. The SAVE plan, as probably some of you know, was one of the income-driven repayment plans. And when I say and talk about income-driven repayment plans, or IDR plans, that's an umbrella term for a bunch of different plans that we're going to be talking about that are based on your income, including the SAVE plan. The SAVE plan was introduced in the fall of 2023 by the Biden administration, and it was going to be, for the vast majority of federal student loan borrowers, the cheapest repayment plan available. It was almost immediately confronted with legal challenges. In July of 2024, a court placed an injunction on the Department of Education that prevented them from enrolling new borrowers or billing people in the plan. And everybody that was in that plan, which at the time was probably over 8 million borrowers, was put into a forbearance, where about 7 million borrowers still remain in that forbearance. It started out as a non-interest bearing forbearance. It turned into an interest bearing forbearance as of August of last year. And time spent in the SAVE forbearance does not count towards forgiveness programs like PSLF or IDR forgiveness. Now, the OBBBA would have eliminated this plan in July of 2028, along with some other plans that we're going to talk about. But after recently a few months of legal wranglings and back and forth with the plaintiffs and the defendants and the courts, the courts finally approved a settlement agreement between the two parties that has effectively eliminated the plan. That was done on March 10th, and the SAVE rule was vacated. So this plan is now officially dead. However, the forbearance remains in place. So where we are right now with this is that if you're in the SAVE forbearance, we're waiting for the Department of Education to provide guidance as to when all these 7 million borrowers are going to have to transition out of the SAVE plan. Eventually, you will have to do this. You don't have to do it immediately. But if you're ready to do it, you also do not have to wait for them to come out with this guidance. You can switch out of that plan anytime you like, and we're going to talk a little bit more about that as we go through the presentation. So that's the SAVE plan. Now, for future borrowers, If you are taking out a new loan or consolidating an existing loan on or after July 1st of 2026, you're going to have limited options for paying your loans back. At most, you will have two options. The first option is going to be a new version of a standard fixed repayment plan. These standard plans, the payments are based on the size of the loan, the interest rate, and a predetermined payback period that in this new plan is going to range from 10 to 25 years, depending on how big your debt is. And that is going to be available to both student and parent plus borrowers. And standard plans function like kind of regular consumer debt. It's the equivalent of paying a mortgage where you're making one monthly payment over some time period. After you've made all those payments, you've paid back the entire loan, including all of the interest. The second repayment plan that people will have access to is called the Repayment Assistance Plan, or the RAP plan. This is going to be the only income-driven repayment plan, a plan that's based on your income and not on the loan balance. It's going to be the only IDR plan available to new borrowers. And if you consolidate an existing loan on or after July 1st of 2026, you're going to be considered a new borrower. And in addition, this is only going to be available to student borrowers with direct loans. So if you're a future Parent Plus borrower, what this all means is that you will not have access to any plans that are based on income, which basically shuts down access to forgiveness programs like public service loan forgiveness. And we're going to be talking a lot more about that as we go through the presentation. But how are the payments calculated in the RAP plan? It's going to be based on your adjusted gross income, a straight 1 to 10% of your adjusted gross income based on your income size. That's for incomes of $10,000 or more. The base payment would be reduced by $50 for each dependent that you claim on your tax return. That's a less generous treatment of family size than is currently in existence with the existing IDR plans. There will be a minimum payment of $10 on this plan. Under the existing IDR plans, if you have no income or very, very low income, you can get a $0 plan. Not so in the RAP plan. You will have to pay at least $10. Now, there are some good aspects of the RAP plan. So unpaid interest does not accrue in this plan. Now, a lot of you may be sitting with loans, and one of the ways that student loans work, if you're in a plan that's based on your income and your income is low or moderate compared to your debt size, the monthly payment that you're required to give does not cover the entire amount of interest. So what happens in the existing plans is you make your payment, your loans are in good standing, but the unpaid interest gets added to your account every month. And that's why people continually scream and pull their hair out about their student loans, saying, I'm making payments, but my balance is going up, and they don't understand why. So that will not happen in the RAP plan as long as you make the minimum required payment, whatever that required payment is. If it's only $10, it doesn't matter. You will not see your balances increase. In fact, you might see a principal balance decrease because there's going to be a principal subsidy up to $50. So if your required payment does not pay your principal down by at least $50, the government's going to kick in up to $50 to make sure that happens. So this is a really good feature of the RAP plan that counterbalances some of the other features that are not so great. But this can work for certain borrowers in certain types of situations. Spousal income, if you're married, can be excluded for the purposes of calculating the payment if you file your taxes separately. This is a common way that married borrowers can try to keep their student loan payments down by basing the payment on only their income if they're married, rather than both of the incomes combined. On the downside, there is no protected income in this repayment plan. There's no cap, and there's no adjustment for inflation, which could make the payment it's less affordable, let's put it that way, as time goes on. Under the existing repayment plans, the payment formula adjusts every year for inflation. This plan does not do that. All of the current income-driven repayment plans offer forgiveness. This is separate from public service loan forgiveness. If you don't have a PSLF job, they offer forgiveness after you make payments after 20 or 25 years on the current plans. That type of forgiveness under the wrap plan is going to be 30 years. So you're going to have to stay in it longer in order to get that type of loan forgiveness. And payments in the wrap plan will qualify for public service loan forgiveness. That remains a 10-year path to forgiveness. So this slide is just an example of what payments in these new plans might look like. Now, this may differ depending on different variables. So on the left-hand side, I've got the new standard, the tiered fixed repayment plan. And I used an interest rate of 6.5%. So these numbers will change depending on what the interest rate is, but the payment period is going to be the same. And at 6.5%, you can see that your monthly payment on a 10-year plan would be about up to $284. If your loan balance is over $100,000, the monthly payment could be $675 or more. So it's going to be really important, particularly for parent borrowers going forward, since you may not have access to the income-driven repayment plans any longer. Before you sign on the dotted line to take on a ton of debt, you want to know what your total debt is going to look like at the end of the borrowing period and what kind of payment you're going to have to make to service that debt, and make sure that you can afford it. Because if you can't, you might have to course correct before your kids start school. The wrap plan on the right, this assumes that the individual has no dependents. If you add dependents, those monthly payments will decrease a little bit. All right, so under the new budget bill, there is a rule. We call it the pay under the same plan rule. I don't know if that's the official name for it, but that's what I call it. And what this rule says is that all of your loans must be paid back in the same repayment plan. And this is going to apply to both student borrowers and Parent Plus borrowers. So what this means is that if you take a new loan or you consolidate an existing loan on or after July 1st of 2026, if you're a student borrower, then all of your loans, including all the older loans, must be paid back in either the wrap plan or the new standard plan. So you will no longer have access to any of the existing income-driven repayment plans. Even more importantly, if you're a Parent Plus borrower and you take new loans or consolidate existing loans on or after July 1st of 2026, all your loans, including all the older ones, must be paid back in only that standard plan. So even if you're consolidated, you will not have access to the wrap plan in the future, and that effectively cuts off a path towards public service loan forgiveness or income-driven repayment forgiveness. You would still have access to other types of discharge, like disability discharge, but for those specific forgiveness programs, you would no longer be able to access those programs under this new rule. The one exception here is if you have both student loans for yourself and Parent Plus loans, you can pay the student loans back in the wrap plan while you're paying the Parent Plus loans back in a standard plan. So that means you would be able to pursue forgiveness for your own student loans, but not for the Parent Plus loans. Okay. So now we're going to talk about what we call legacy borrowers. And a legacy borrower is somebody who is not planning to take out any additional debt or consolidate new loans on or after July 1st of 2026. If you're a legacy student borrower, what you're going to have access to is some of the existing repayment plans, so payee and ICR, if you're eligible. You'd have access to these rules, to these plans under the current rules up until July 1st of 2028, which is when those plans are going to be phased out. Thereafter, or even before, you would have access to the income-based repayment plan, or IBR. That is the one existing plan that is going to continue to live on for anybody who is a legacy borrower. New borrowers will not be able to gain access to it, but if you're a legacy borrower fitting that definition, you'll have access to IBR or the wrap plan when that becomes available in July. And you'll be able to access both of those plans until your debt is either forgiven or paid off. Now, the income-based repayment plan, or IBR plan, used to have an income test, so some borrowers were not eligible to get into it. It no longer has that income test. So virtually anybody that's got a direct or even these older FFEL loans can get into the IBR plan. And it does have a payment cap. So you never have to pay more than the standard 10-year fixed repayment rate in the IBR plan. There's two different versions of the plan. Payments are calculated at either 10% or 15% of discretionary income. Depends on when the loans were dispersed. If your first loans were dispersed from July 1st of 2014 through June 30th of this year, you would have access to the cheaper version of that plan, which also has a 20-year path to forgiveness. If you have any loans that were dispersed before July of 2014, you're only eligible for the more expensive version of that plan with a 25-year path to forgiveness. Now, here's where it gets really dicey and important for Parent Plus borrowers. If you're a legacy Parent Plus borrower, so you're done borrowing for your kids, you are going to have access to income-driven repayment plans and forgiveness programs, but you may have to take action. And the biggest and most important date is looming. You must have, if your loans are not consolidated, if you have just direct Parent Plus loans, they're not consolidated, you must consolidate your loans and have a fully consolidated dispersed loan before July 1st of 2026. So this is what we call a completion deadline, not a submission deadline, meaning that you can't just submit the application for a consolidation on June 29th and meet the deadline. You actually have to complete the entire process. And the consolidation process generally takes 4 to 6 weeks. These applications are processing pretty normally right now. So there is time, and we've been recommending that people submit the consolidation applications no later than March 31st or April 1st, but these are not hard and fast deadlines. I think there is time, probably at least through much of April, to consolidate and get the new direct consolidation loan dispersed prior to July 1st of 2026, which is kind of the witching hour for these loans. Once you do consolidate, you must enroll in the ICR plan. That's one of those income-driven repayment plans, and make one payment in that plan. After you do that, you can then access the income-based repayment plan, because remember, the ICR plan is going to be phased out. And generally, IBR is going to be cheaper for most borrowers than ICR. So most people are probably going to want to access the IBR as soon as possible. The important thing to know is that for purposes of a deadline, the enrolling in the ICR plan and making that one payment does not have to be completed by July 1st of this year. It just must be completed before the plan is phased out. We're not recommending that you wait too long to do that, but the key thing right now is to make sure that your loans are consolidated. So if you need to submit a consolidation application, you want to be doing that in the next few weeks. And just remember that older loans that are consolidated on or after July 1st of 2026 are going to be considered a new loan, and it's going to make all of your entire loan balance subject to these new, more restrictive repayment options. And for Parent Plus loans, that means no access to IDR, no access to forgiveness. Other rule changes for loans that are dispersed on or after July 1st of 2027, you will no longer have access to an unemployment or an economic hardship deferment. Although I will say, at least for a student borrower that is eligible for unemployment and economic hardship deferments, in the future, you would probably be likely eligible for a very low payment in the RAP plan. Or if you still have access to the legacy plans, you might be able to access a $0 plan. So that's something that you would want to check out. More importantly, general forbearances under these new rules, you can only request a general forbearance, which is a means of temporarily suspending your payments and keeping your loans in good standing in the process. You can only request a general forbearance for 9 months during any 2-year period. Right now, you can take up to 3 years of forbearance over the life of a loan. Also, starting on July 1st of 2027, borrowers will be able to access loan rehabilitation, which is one of the ways you can get your loans out of default, twice. Right now, the rule is you can only do a loan rehabilitation on a loan once. And then there's some changes to the borrower defense to repayment and closed school discharge programs, but I'm going to skip that for now. All right, I'm going to stop there. And Yorick, were there any questions that need to be answered?
Just my own, but it was already answered. I asked a clarifying question, and I'll say it out loud so maybe if people aren't looking at the chat. So it was specifically about the RAP repayment program. Would it be applicable to grandfathered grad plus students?
Yes. So that's why the grandfathering rules for graduate students are better than they are for parent plus bars. It's just that like I said, you're going to be grandfathered under the current borrowing limits, but you have to repay under the new rules. So your only income-driven repayment option will be the RAP plan.
Perfect. Thank you so much. There's
Okay.
no other questions in the chat.
Okay. All right, so let's move on to the whole issue of creating a long-term plan. So when people come to see us, they generally are looking to address a specific issue. They can't afford their payments. They're on the brink of going into default, and they want to avoid that, or they're in default and they want to come out. And of course, we always want to um, address the immediate issues, but we also want to leave. If I can ask everybody to please mute your microphones if you're not on mute, I'd appreciate it. We want everybody, in addition to just solving the immediate issue, to have a long-term strategy for getting rid of their debt. Because after all, this is everybody's goal is to eventually eliminate this debt. So we start by trying to identify three forgiveness programs because unlike most other types of consumer debt, within the federal student loan system, not every strategy involves entirely paying your debt off. So you kind of have to know what you're eligible for before you figure out what your long-term strategy is going to be. So the first thing we do is let's just talk about the big repayment forgiveness programs that are out there that can help people eliminate their debt without paying the entire amount off. So the first one is income-driven repayment or IDR forgiveness. We call it IDRF. And that forgives balances after you make 20 to 30 years of qualifying payments in one of the income-driven repayment plans, IBR, Payee, ICR, or RAP. Whether it's 20, 25, or 30 years depends on which repayment plan you're in and which one you're eligible for. There's no employment requirement of this program, and any credit that you may have accumulated towards IDR forgiveness in SAVE, Payee, and ICR, all plans that are either already expired or going away. Any credit that you already accumulated, you will not lose that credit. It will be transferred to either IBR or RAP if that's where you wind up. There was a program called the IDR account adjustment, which awarded retroactive credit towards IDR forgiveness based on a set of relaxed rules that was done during the Biden administration. Borrowers needed to have direct or Department of Education held loans by June 30th of 2024 to benefit. So some people may have had to consolidate, others just needed to make sure, they would just automatically get this credit if they already had held debt. And people are still benefiting from the credit that they accrued during this one-time account revision. It's over. You can't accrue additional credit this way. But some people accrued substantial credit towards this long-term forgiveness program because of this one-time account revision. Now, just a big caution here. If you're considering consolidation and you're pursuing IDR forgiveness, if you consolidate right now, you're going to wipe out any accumulated credit that you might have already accumulated. So you probably want to reach out to EDCAP for a one-on-one consultation before you do that, because once you consolidate, you generally can't go back. It's once you've done that, you've done that. Forgiven balances in this particular program may be taxable starting this year. So there was a tax exclusion that was applied to this program due to COVID that expired at the end of 2025. If you're getting loan forgiveness and IDR forgiveness from here on in, you may be subject to taxes on that forgiven balances. They treat it like income. Public Service Loan Forgiveness, or PSLF, this is the program where you make 120 qualifying monthly payments, that's 10 years of payments, after which your remaining loan balances are forgiven. And a qualifying payment is defined as an on-time payment made in full on or after October 1st, 2007. So that's when the program started. If you made payments before then, they'll count towards paying your loan down, but they will not count towards public service loan forgiveness. You also must have direct loans. You must be in an income-driven repayment plan. And you must, sorry, some payments in a standard 10-year fixed repayment plan also qualify. But if you remain in that standard 10-year fixed plan throughout the life of the loan, there will be nothing left to forgive because you'll have paid the entire thing off. So at some point, you will have had to transition to an IDR plan. And then there are employment requirements. So you must work an average of at least 30 hours per week for one or more qualifying employers, and a qualifying employer is generally a nonprofit or a government. If you're working more than one job, you must do that concurrently so that you meet the 30 hours per week employment requirement. The payments do not have to be consecutive. You could be working in the public sector and earn, let's say, 3 years of credit towards PSLF, and then you leave. You go to the private world for a couple of years. If you come back, you will not lose those 3 years that you just accrued. You'll just pick up where you left off. If you are about to achieve the 120 qualifying payments and you're about ready to file that last form that would get you to 120 qualifying payments, you have to be meeting the employment requirements at the time you submit that last application. So if you think that you're going to be eligible for 120 qualifying payments in April, you don't want to quit your job on April 1st when your payment isn't due until April 10th. You want to make sure that you make the payment in April, then file the application. And if you're thinking about quitting or retiring or moving to the private sector, you do that after you file that last application. And ideally, if you can wait till the application is processed to be sure, you probably should do that as well. But you don't necessarily have to do that. Then there's something called the PSLF buyback program, which allows you to purchase months spent in a disqualifying payment status, such as the save forbearance. So all those months that people have been sitting in the save forbearance, you've not been accumulating credit towards public service loan forgiveness, but you might be able to buy back all those months by submitting this request. There are requirements before you have to have 120 qualifying months of employment on record. Whatever you're buying back must get you to 120 qualifying payments. So there are requirements that you have to meet before you're eligible for this. But once you're eligible, you can submit the application. It's relatively simple to do. There's a link here to the reconsideration portal, and it's pretty self-explanatory once there. You cannot buy back time spent in a school deferment, grace period, or default. You can't buy back months prior to consolidation. The key thing that I want to say about this program is that, or about the buyback program, is that the processing of these applications is painfully slow. Apparently, it's very labor intensive. They have not allocated much resources to this program. So the backlog is up to like 88,000 applications, and the estimated time to clear that backlog is running at about 3 years. So we'll talk a little bit more about that later. One of the key features of the PSLF program is that forgiven balances are not taxable at the federal or the state level in New York. You may be reading a lot of articles about how student loans are forgiveness is taxable in 2026. That is true for that previous program, the IDR forgiveness program that I mentioned. It does not apply to PSLF. PSLF is its own law, has its own rules, and it is not, at this time anyway, the forgiven balances are not taxable. So it's a 10-year path to forgiveness with no taxation of the forgiveness amount. So it's a great program if you're eligible for it. PSLF borrowers, if you're pursuing public service loan forgiveness, you need to submit what's called a PSLF certification form. These forms verify that you've met the employment requirements of the program, and you can't get an official qualifying payment count unless you submit these applications. And you need to submit at least one certification form for every employer that you've had since October 1st of 2007 or later if your loans were dispersed later. There's no deadline for submitting, but you should submit them annually or whenever you change jobs. And by far and away, the most efficient way to do this is by using the PSLF help tool from your federal student aid account at studentaid.gov and selecting and requesting an electronic signature from your employer. So that way the employer is going to get like a DocuSign document from the Department of Education. They open it, they click it, goes right back to the Department of Education. You don't have to touch it. People who are submitting the forms this way are getting really quick updates on their qualifying payment counts. I've seen this turn around in sometimes less than a week. If you submit anything with a manual signature, you could be waiting months for it to process. So wherever possible, we strongly submit that we strongly recommend that you submit these requests in this manner. And then total and permanent disability discharge. This is a program for people who maybe over the course of time develop a physical or mental disability or have some kind of chronic condition that prevents them from engaging in activities that would allow them to earn a livable wage. So it does not mean that you cannot work at all. It doesn't mean that you have to be bedridden or in a wheelchair or in a hospital. It just means that you meet these particular requirements. There's more specifics about it that you can read about when you get the deck. There's 3 ways to apply for TPD if you are a veteran and meet certain requirements, if you're on Social Security and you meet the requirements under Social Security, or if you can get a medical professional to sign off on a certification form. So if that describes you, again, you can reach out to us and we can help you submit the application. So once you've kind of gone through all of these forgiveness programs and you have determined what you may or may not be eligible for, then you're going to develop a strategy. And we have basically found that, in the thousands of meetings that we've done over the last 7 years or so, people are going to fall into one of 3 buckets in terms of their eliminating debt strategy. The first bucket is going to be to pay the debt off in full as quickly as possible. So this is going to be best for people who have higher income in comparison to their loan balances. They may have the ability to make more than the required payments every month or even make lump sum payments. If this is your strategy to just pay it off completely, the faster you do it, the less you will pay overall because you're paying less in interest. So be as aggressive as possible in your monthly payments or the lump sums, and then it will save you some money down the road. The middle bucket is probably where the majority of our clients are, and that is for people who have larger loan balances, low to moderate incomes. You identify a forgiveness program, one of those first two forgiveness programs that I talked about, IDR forgiveness or PSLF, and make the minimum required payments until such time as you have achieved forgiveness. So this is a very viable strategy within the federal student loan system that does not require that you pay your entire debt. So for all those people that were kind of tearing their hair out about their making the payments and their loan balances going up, they may not have realized it, but really what they were doing was pursuing one of these forgiveness programs. And if they weren't eligible for public service loan forgiveness, they were going to be pursuing that longer term IDR forgiveness program that would allow you to get rid of your debt within 20 to now 30 years, which is still a long time. But if your debt is very large and your income is moderate, you may not have a choice because you wouldn't be able to afford the payments in a standard repayment plan. So in most cases, you're going to want to be enrolled in an income-driven repayment plan when you're pursuing this strategy. And then the last strategy, pay the minimum required until death do you part, sounds a little depressing, but we have it there for a reason. So in the federal student loan system, Um, loans that are federal student loans are discharged in death. And what that means is that if you, the primary borrower, dies, your loan obligation does not accrue to your estate, which happens frequently with private debt or other types of consumer debt. If the borrower dies, it becomes part of the estate and then becomes part of what the family or the executors of the estate have to manage. That doesn't happen in the federal student loan system. So this strategy is going to be probably more geared towards older borrowers who may have taken out late in life loans for themselves, or they may have a bunch of Parent Plus loans, but they're either at or in retirement, so they no longer have access to public service loan forgiveness, and they may be faced with making payments for 20 or 30 years, which could be the rest of their lives. In these instances, you want to just identify the cheapest possible plan. It can be an IDR plan, it can be a traditional plan, and make those payments until you pass understanding that it's not going to be a problem for your family. Okay, getting into the home stretch here. Just some guidance for borrowers going forward, sort of combining everything that we just spoke about. If you're pursuing public service loan forgiveness or IDR forgiveness, if you're enrolled in IBR, Payee, or ICR, which are the three plans that are currently available, keep making those payments so that you can earn additional credit towards PSLF and IDR forgiveness. Remember, borrowers in Payee or ICR who need to make payments beyond July of 2028 will be able to transition to IBR or RAP, assuming they assuming they are either legacy student borrowers or they're some kind of a student borrower. Legacy Parent Plus borrowers will also have access to income-based repayment as well. For PSLF borrowers, you can submit that buyback request if you're eligible, the one that we were just talking about that would allow you to buy back time spent in a disqualifying status. But we don't necessarily recommend that you rely on this alone to get you to your 120 qualifying payments because of that massive backlog and the amount of time we think it's going to take to clear that backlog. So if you basically are looking to buy back, 18 months worth of payments, but it's going to take 36 months for you to get the actual buyback request, what we're recommending is that you submit the buyback request if you're eligible. There's no downside to doing that, but that you maybe, if you're, let's say, in the SAVE plan, switch out of that plan and into an income-driven repayment plan and start earning credit towards PSLF, and then see which strategy gets you to forgiveness faster. Now, like I said earlier, borrowers do not have to immediately come out of the SAVE forbearance. We don't know exactly when you'll be asked to do that. Best guess, it's going to be in the coming months, certainly by the end of this year. But if you want to stay in the forbearance, there might be some reasons to stay in the forbearance. Temporary relief, if you're just having trouble affording any other repayment plan, you can stay in this SAVE forbearance until they kick you out, which will give you some time to maybe create a strategy. But, like I said, the time may be running out there. Avoiding higher payments. Whenever you submit an income-driven repayment plan application, whether it's to enroll or recertify your existing plan or recalculate it or switch the plan, they're going to ask for your most recent proof of income. If you think that your income is going to drop in the coming months, you might want to stay in the SAVE forbearance for now and wait and submit the IDR application to switch, and for when your income has actually dropped, so the payment will be based on that lower income. If you can't do that, by the way, you can always recalculate it once your income does drop. If you're forced out of the SAVE plan early. And then if you're waiting for the RAP plan, that's that new plan that we described, which for some people is going to be the cheapest option. You might want to wait until it becomes available, which is in July. The SAVE forbearance could end before the RAP plan becomes available. But really, we're getting closer to the date when the RAP plan will be available, so we'll see. And they're going to have to give people, I think, at least a couple of months to get out of the SAVE forbearance. For Parent Plus borrowers, just kind of reiterating, if you're an existing Parent Plus borrower or a legacy Parent Plus borrower, you're done borrowing. You're not going to take out any additional loans for your child. You must consolidate by July 1st, which means you submit those consolidation applications within the next couple of weeks. And then once you're consolidated, you make that payment in ICR before the ICR payment plan is phased out. And thereafter, you'll have access to IBR. If you take out any Parent Plus loans on or after July 1st, or if you consolidate existing loans, no access to the RAP plan, no access to the income-based repayment plan, no access to any IDR plan or forgiveness. So again, if you haven't done the consolidation and IDR enrollment, you want to think about starting that really soon. If you took loans out for the spring of 2026 for your child, you should be able to consolidate those now, even if they're in a deferment. Now, if you do consolidate them and they're in a deferment, they're going to come out of deferment. You can either then start making payments, or you can request a forbearance once the loans are consolidated. But if you need to retain access to those IDR plans and forgiveness, you need to get those consolidated. If you have a defaulted Parent Plus loan, consolidation is one of the ways you can get out of default. Reach out to EDCAP. We'll help you through the process. That will kill two birds with one stone. You'll get yourself out of default. Plus, we will help you meet the July 1st consolidation deadline for Parent Plus borrowers. Now, if you're planning to borrow after July 1st of 2026 for your child, if you do that, you're going to be locked into the standard plan for all of your debt. So this is something that, frankly, in the past we have never done before, but parents that are in this situation, and I'll give you an example. Maybe you have accumulated 3 years worth of Parent Plus loans for your child who's about to go into their senior year. And you yourself are pursuing public service loan forgiveness. So the bulk of your debt you've already taken out. It's in federal student loans, but you have to borrow for that final year to finish, so your child can finish school. You might consider taking a private loan for that final year, and that will protect and preserve your existing debt. You want to make sure that it's all consolidated, to make sure that you will have access to forgiveness on that federal debt, which is the bulk of your debt that you've accumulated up till now. Again, you can reach out to us if you have any questions or you want help with that strategy. Couple of words about delinquency and default, and then I think we'll be done. So there is, you may have read some of the headlines about the default rates on federal student loans skyrocketing, which they have. So for many years during COVID, borrowers actually could not default, and there were programs in place to help them get out of default. But all of that COVID relief expired, and now people are sort of defaulting in record numbers. What happens when you default is after 30 days of if basically missing 1 month's worth of payments, you're considered to be delinquent. And after 30 days, they're going to assess a late fee. After 90 days of delinquencies, they're going to report you to the credit agencies. After 270 days or 9 months, that's the point at which you become at risk of default. And what it means to be in default is that the debt is payable immediately and in full, which is a non-starter for most people who are in default. You have no access to repayment plans that are based on your income. You have no access to forbearance, deferment. You can't earn credit towards forgiveness. And if you're looking to further your education, you don't have access to federal student aid. And of course, the biggest thing is when you go into default is you're at risk of involuntary collections, which currently is on pause. But the government can collect administratively, meaning they do not have to take you to court. And the 3 ways in which they typically do this is by taking up to 100% of your tax returns, by offsetting up to 15% of your Social Security, but they have to leave you with a certain minimum level. Also by garnishing up to 15% of your disposable pay, but also leaving you with a certain minimum. They can do all these 3 things without a court order. They would just simply issue you a notice. There would be some heads up. You would have some limited period of time to either contest it or take some actions to get yourself out of default to prevent that from happening. after which they go ahead with collections. So the collections are on pause, like I said a little bit earlier. They have not said when they plan to restart collections. Again, we don't think it's going to be earlier than July, but you never know. Our best advice is that you take action now to get yourself out of default so that when they turn the switch back on, and they can turn it on with relatively limited notice, you're ready and you would not subject yourself to this. And the good news is that within the federal student loan system, there are ways to get out of default. You can either do it through a consolidation where you just replace your old defaulted loans with a new consolidation loan, or something called loan rehabilitation where you make 9 payments over a 10-month period. There are pluses and minuses to each of these methods. Not everybody is going to be eligible for both, and some people will not be eligible for either. But if you're in default, reach out and we will make sure that we choose the right path for you. Finally, just a little bit about our contact information if you're looking for a one-on-one. There's 3 ways to contact us. We have a live helpline that's available Mondays through Fridays from 9 to 4. We have a program email, edcap at cssny.org. You can also book appointments with us online. Now, I will say that we're pretty heavily booked right now, and if you try to book an appointment online and you're getting something that's way out, but your situation is a little bit more pressing, call the helpline or send an email and we'll try to fit you in faster. So that concludes the program, and glad to see that some people are still with us. Yarick, were there any lingering questions? So I want to thank you guys all again for sticking with this on a Wednesday evening, and we look forward to hearing from you if you need individual help. And thank you to Yorick, and thank you to the Assemblywoman as well. Good night.